Welcome to the Commercial Real Estate Academy podcast, the podcast dedicated to simplifying the commercial real estate industry for the masses. Each week, we sit down with industry experts to dissect the many facets of commercial real estate and extract valuable lessons you can apply to your business. Whether you're a new or seasoned business owner or investor, the Commercial Real Estate Academy podcast will be your go-to resource for all your commercial real estate needs. Now, here are your hosts, Raphael, Collazo, and Jeff Walston.
Welcome to the Commercial Real Estate Academy podcast. I'm your host, Raphael Collazo, here with my co-host, Jeff Walston. How's it going, my friend?
Oh, well, man. Trying to get some of these projects wound up for this holiday weekend that we're coming into. So that's been crazy busy, just trying to stack as much as I can in 3 or 4 days of this week. But it's working out. Other than that, everything's going well. What about you, Raphael? How's it going over there?
Yeah, it's going great, man. Obviously we got the bachelor party coming up. It's should be an exciting time. And then other than that, work's going well. I mean, I got a lot of leasing activity, as I've mentioned in a couple of the previous episodes as well. Very active on that front. Buy side has been kind of, people are hesitant right now, given what the interest rate environment looks like, but I think that'll normalize here soon as well. But other than that, everything else has been going real well. And, speaking of just a doing well and having a phenomenal conversation, we had the honor and privilege of interviewing Whitney Elkins-Hutten, Director of Investor Relations with PassiveInvesting.com. And we touched on a variety of different topics throughout the podcast. And I actually had the honor of interviewing Whitney on a good friend of ours podcast, Chad Griffiths. He runs the Industrial Real Estate Investing podcast. And we got to dive in a little bit on the self-storage front over there. But this focus of this particular episode, we touched on her backstory and the variety of different things that she's been doing ever since she got into the investing space. So we start off, talk a little bit about how she got into investing in the first place, some of the early struggles she faced as she worked to scale her residential portfolio. She got up to, I think, 30 units before she realized that she was burning the candle at both ends and just couldn't sustain it anymore. And that's when she decided to kind of transition into the commercial route. She works for a company called PassiveInvesting.com, and they invest in a variety of different verticals, including multifamily, self-storage, car washes, hotels. She herself is involved in a residential long-term health facility. So she has a very diverse idea and understanding of all the different opportunities out there as it pertains to those different verticals. And so we touched on some of the things that passive investors, so if you're someone who is actively working in a role in your job, or you have a company you're focused on one vertical and you don't have the time to invest in, a car wash operator, a car wash business, or a hotel or multifamily property, being able to invest passively by handing off your hard-earned money to other people so they can invest and make sure that the investment performs as intended is what is a common practice, in these different spaces. And, as an operator, that's really, where you yourself have to vet the operator, make sure they have the experience to make sure that you're going to be prosperous in that endeavor. And so she talks a little bit about some of the things you need to look out for from a passing investment standpoint to make sure you're placing your money with a reputable operator, and then some of the things that they do on their front to make sure that they're able to achieve the proper returns for their investors while mitigating as much risk as they can, and understanding that there is inherent risk in everything. You can't mitigate risk altogether, but an experienced operator should be able to mitigate as much risk as they can and then minimize the chances of a negative event occurring. So I thought it was a great conversation. And like I said before, I had a chance to talk to Whitney in the past, and she was just a wealth of knowledge back then. And I thought it would be great to have her on the podcast now so she could share her insights there. So Jeff, did you have anything like that?
Whitney was a wealth of knowledge, like you said, and I feel like she gave a lot of value in this episode. I also wanted to say that she not only is it the knowledge that she gained, but she gained it from experience with all the failures that she did over the years, and she goes into the episode of a couple of those things too as well. So I'm excited for everyone to listen to this podcast episode. And on another note, this podcast is free to listen to. It's not a chargeable thing, but there is a fee that I like to say, and that's just a recommendation. to a new listener out there, someone that you think that could gain value. They don't have to be in the commercial real estate arena, but if they're interested in it, I think that we could really give them some value and help them out, and actually put them on a better path if they listen to us. So and all those who have actually done that, we really appreciate that your time for recommending the podcast. But other than that, Raphael.
Yeah, no, I couldn't agree more. I mean, we're definitely always very appreciative of the fact that you guys have been so supportive of us throughout the years. And, you know, if you guys have an opportunity to share this with this episode with someone who you think could gain a value, obviously it would be the biggest compliment that we could receive. You know, our mission is to spread the message so that we can simplify the commercial real estate industry for the masses. And part of that is making sure that more and more people can actually listen to our episodes and make sure that they're gaining value from it. Along with that, we always ask if you could leave us a 5-star review. It would mean the world to us. I think now we're pushing, if not surpass, 60 reviews. So it's pretty impressive to see the reach and growth that we have achieved. And, you know, a big part of that is because of you guys. So if you guys don't mind, I know if you're driving, you know, be safe and focus on the road. But if you guys have a chance to be able to leave a 5-star review on Apple Podcasts or Spotify, it definitely would mean the world to us. So thank you all so much for your support. And without further ado, let's go ahead and dive into the podcast. Well, hey, Whitney, great to see you this fine afternoon.
Yeah, thanks for having me on.
Yeah, thank you for taking the time and come on. I know we're about to be in a holiday weekend, so thank you.
Oh,
doing that.
absolutely. Yeah, I've got all my bags stacked up. We're ready to bolt out the door ourselves.
That's awesome. Yeah. And for those of you guys who are listening, I actually had the honor to be able to interview Whitney on one of our good friends' podcasts. He's been a guest of ours as well, Chad Griffiths. So we're really excited to dive into your backstory, because I know you gave a lot of value on that podcast, and I know you'll be able to provide us with a ton of insights as well. So typically what we like to do when we first get started with a podcast episode is we like to learn a little bit more about the person that's across the table from us. So if you don't mind kind of sharing your backstory, I think that'd be awesome.
Yeah, definitely. So I am an accidental landlord. Where I am now, I'm the director of investor education at passiveinvesting.com. I've actually been in the private equities world for a while, as a director of investor relations and operations at a different private equity group that worked with passiveinvesting.com. But I'm here now full time, which I'm so excited. But it wasn't always like that. I started off as a accidental landlord back in 2002, bought a house with a significant other, and relationship fell apart about a month later, and I had a house and all the bills that came along with owning that house. And I was very nervous. It was in my 20s, and I was like, oh man, what am I going to do? So stuffed it full of roommates who didn't mind living in a construction zone, paid them in pizza and beer, and we rehabbed a house together. And I sold it about 11 months later and made 52 grand, and then realized, it was after I closed that I realized, man, I have not been paying for anything for the past 11 months. I've been making money. And I was like, how many more of these projects can I do? So did a couple more on my own. And then with my now husband, we're actually living in, not this is it's great if you guys are watching live, but this is my dream. This is what I'm manifesting for our next house hacking project. But we're still living actually in our last house hacking project. But we realized after doing several of those projects, we were really good at creating equity, but very bad at creating cash flow, which is what we needed to unlock those golden handcuffs. And then we transitioned into buy and hold real estate, kind of slapped ourselves in the head. We're like, oh, we're doing all these rehabs. We need to hold on to a few of them. And, we built up a portfolio of 30 single family homes that way. And then we hit a next level of achievement, is that I had another job. I was burning the candle at both ends, 5 times in the middle, taking care of family members. We had a baby at home then. I was like, this is unsustainable. And then I was like, man, that's when, and I had just haphazardly, honestly, invested in a couple of passive real estate deals with my self-directed IRA. And that's when I was like, we need to go into multifamily. We need to buy more units with each transaction. But then I was looking at my self-directed IRA and I'm like, I'm not doing anything to get those returns. And, I also have the exposure to commercial real estate. And so we actually, did a combo strategy, kind of like what I do everything in life. I went and learned that stuff very actively, but also tried to figure out as quickly as possible, how can I become passive in that investment strategy? So we scaled up as general partners in a few deals, and then also just as quickly as we could shovel as much as we could over to our passive strategy. So that's a lot, but I love kind of like going there because so many listeners are on different parts of their journey. And so, maybe we, whichever would resonate with your investors, we can kind of touch on that area.
Absolutely. Yeah. And I think it's important that you shared that story because, it wasn't like you just all of a sudden were said, hey, I'm going to become the biggest investor in the world. It was you kind of became an investor out of necessity and then realized that, oh, this can actually be something that can really change the trajectory of my life. And so, I think that it's good insight for you to share because a lot of people, think they see these people who are doing some, pie in the sky type of investing, which, it took them years to get there. Most people don't, get there in a day. It takes 20, 30 years to become an overnight success, as they say. So
I was going to say exactly that. I'm about a 20-year overnight success, but honestly, I probably could have gotten there much quicker. Think about it, like 20 years ago, we didn't have YouTube. I was learning how to rehab this house with a book from Home Depot. Just think about what you can learn now and the skills that you can learn and how you can collapse time now. I'm so excited for my daughter, growing up in this time period. I mean, just what is she going to be able to achieve? But yeah, it's like an iceberg, right? I talk to investors all the time and they're like, I want to be like you. They see me with 6,300 multifamily units or residential units, over 6,000 self-storage units, all these car washes. But I was like, that's the teeny top of a very large iceberg that's underwater. There's a lot of mechanics that happen under, over the past 20 years to really set us up for where we are today.
Absolutely.
So you said that you have storage units and then multifamily, car washes. Is there anything else any other avenues that you guys are looking to go down or?
Well, personally, professionally, with passiveinvesting.com, we invest in multifamily self-storage, car washes, hotels, and we also have a real estate debt fund. Personally, I've invested in all of those, verticals, as well as I have a residential assisted living building. I have a mobile home park. I have Airbnbs. So I still have some single family rentals, honestly, I trimmed down our portfolio to some of the highest performers and they're pretty much paid off. So I know everybody says, keep them levered up, but that's just easy cash flow for me to turn on right now.
Yeah. And debt is a double-edged sword. I think a lot of people think, oh yeah, lever to the hilt, but you don't know into who's swimming without their draws without when the tide comes in, right? So it's one of those things where I think it's smart to have a little bit of, fully paid off stuff and then also have some that's a little bit more levered to kind of amplify those returns. But to each their own, as they say.
Well, I had to get started with leverage. I mean, that was what, helped propel us down our path. And I'm glad I did it that way. I mean, it would have been, we would not be talking. If I had not used leverage. But at some point in time, when and I'm not saying we're done with our accumulation phase of our portfolio, but at some point in time, you're just like, is it really that worth it to have that loan over there? Like, what's my risk? What's my exposure? And I don't have any, the golden ticket loans anymore. I moved into commercial debt a long time ago. And so, some of these, portfolio loans with prepayment penalties and all that, I'm like, let's just get rid of that.
Yeah, that's really nice. We actually, when you guys going back to the passive investing and actually having and leveraging that, we actually have a buddy of ours. He's got a good mix of that as well. And he spoke of it once before about how that actually, to him, just keeping that balance actually makes sense, like you said. So don't feel like you're alone and out there with yours just being paid off and just reaping the benefits. It's there's a lot of them out there, I think that way, in my opinion. So but
I mean, especially when we're talking about passive real estate, I mean, that's something, if listeners here are trying to evaluate, do I go in on a passive deal? Like, now is the time in this type of recessionary environment. And, I know the Fed hasn't formally called a recession. I don't know how or not, but anyways, I'm particularly acting like I am, that we're in that type of environment, but it really hasn't changed my strategy. I mean, I'm investing on principle. The deal has to cash flow. It has to have mechanics to build equity, either forced equity into the deal, not just relying on appreciation. It also has to have tax benefits. It has to have capital preservation. But a huge component of this, especially right now in this environment, is the leverage, right? It has to have the right type of debt. If you can get fixed rate debt and it works with a fixed rate debt, that's amazing. I see a lot of operators these days that are using, floating rate debt or more construction loan type debt. And you have to make sure, especially like on, syndicated projects, the debt has to be at least for the term of the hold period, maybe longer, hopefully longer, and it has to be capped because otherwise you're taking on it and with the ability to extend the debt. That would be the other caveat. And I've seen a lot of deals, a lot of operators that are like, wow, we bought this property a year ago. We put, floating rate debt on it, and maybe they bought a cap, maybe they thought they weren't ever going to use it, but now they're having to suspend distributions or lower investor distributions because of that. You want to make sure that you're with a great operating team that are actually looking at all of those pieces related to the debt of the project, and making good decisions not only for the project but for you as the investor. It's your money.
Absolutely. Yeah, I know.
Great
And
advice.
that's where the experience comes into play for sure, because you're right. I mean, there's going to be situations where it's hard to really know exactly what's going to happen. But if you've had someone who has gone through the rinse and repeat cycle multiple different times, they can start thinking about the different scenarios that could potentially go awry, and you can make probabilities about whether or not this is actually going to take place. I mean, I have a client, I work a lot in the, obviously I'm a commercial agent and I work with several car wash clients, and the debts that they're taking on to do construction on for these new projects typically is floating. And then there's different things that they can finagle in order to make sure that they're hitting their metrics as far as what their projections are concerned. So, the debt piece is also very, very important. One thing I was kind of curious about, kind of going back to, your decision to transition to the commercial route, because you had mentioned that you had 30 properties, you realized you were burning the candles at both ends, and it just was not a sustainable, long-term approach. So early on, as you started diving into the commercial realm, what were some of the struggles, if you had any, that you faced, and maybe some of the lessons you could learn or share, impart to others?
Yeah. So, we had built up a residential real estate portfolio, and we decided to transition to and you can do 1 to 4 units residential. You can scale to 80 units with residential real estate and residential debt, like, the government Fannie Mae type debt, which is amazing. I mean, that most people don't ever dream of doing that. For us, we were transitioning into, buildings that were 5 units and larger. So it just changed the game. We had to source a new market, source a new realtor, source a new property manager, new lenders. And so, I felt like that I was rebuilding the company all over again. And there's translatable skills there, but I also didn't know what I didn't know. Like, you're sitting here now talking about commercial debt, and I'm like, a prepayment penalty? Yield maintenance? These are words I didn't know. I'm like, what are you talking about? So it was like another crash course all over again. And so, and I think people get scared about that. Like, to achieve a new level, you have to level up, and it's leveling up your mindset, it's leveling up your skills, it's leveling up your network. And so you can do it actively and you can do it passively. And I think a lot of people, get scared to do it either way. So yeah, that was like our first obstacle that we met, was like redoing everything.
No, it makes sense.
Yeah.
I mean, and I deal it more on the brokerage end, where, I deal sometimes with residential agents that are representing people that are now purchasing commercial property. And I mean, it is a completely different ballgame a lot of times, depending on what the property is. I mean, if you're talking a 5-unit multifamily property, the debt may be slightly different, but for the most part, the components in the building are relatively similar. But even as you start to scale, there's a lot of other moving parts. If there's elevators, there's lifts, there's all these different things that could potentially, impact whether the investment itself turns out to be a good investment for someone. So you're right. I mean, it is a different ball game, but the fact that you're willing to take on the risk of potentially being wrong, but you learn through that experience and ultimately rise up to the new level is definitely great. So
you kind of get paid to learn. And some people actually do pay to learn. Like, the first deal doesn't exactly go according to plan. I mean, we did a JV partnership on a 52 unit building in Indianapolis, and that was like after we solved all those initial puzzle pieces, and then we had to learn about partnerships, and then we had to learn about working with a property management team that somebody else knew, and then relying on them to lease up the entire property, which didn't go smooth. The the leasing agent was fudging the numbers during the holiday season to get a bonus. Fortunately, real estate was pretty forgiving for us, and we still made a little bit of money, but certainly not what we had initially anticipated. But I didn't have to pay $30,000 to get that sort of education. I actually got paid a little bit.
Yeah. I mean, and now, with some of the student debt out there, 120 plus is not uncommon. So, if you could substitute that for learning in the real world and being able to apply a skill that you can, then take to build generational wealth, I think that's a pretty good trade-off if I had to guess.
Well, but again, it requires that the person have like mindset, drive, and it doesn't have a fear to fail.
Mm-hmm.
Or and that's, I don't think I at that last piece, the fear to fail, I think I try to mitigate like as much as I possibly can. And I don't want to fail. But at the same time, it's just like, you got to break a few eggs in order to succeed. That's something that I'm super excited, like, at least for, my child, and the way we've like orchestrated her schooling is, she gets to fail. We let her fail, and she learns so much more by doing that.
Absolutely.
Oh yeah. The best learning is from a failure, in my opinion. You're only going to learn that's actually going to be, excuse me, drilled into your head more efficiently than it was if you're just going through and everything's just fine. But if you fail and I'll learn from that and move on to the next one and gain that knowledge. I think that's great. So
yeah. And you learn that it's not going to kill you. I think that's the biggest fear for a lot of people with anything new is the fear of the unknown. And you create all these different scenarios in your head. And then you realize after you do it, you're like, oh, like, I may have got scuffed up a little bit, but it's not going to kill me. You open up so many more doors for yourself to explore when you kind of allow yourself to just step out into the unknown. And once you realize that, it's not going to kill you.
Yeah. And I think it has to be an incremental process for some people. And I'm going to be like really kind of call that out and be fair. For me, I'm willing to take bets on, hundreds of thousands of dollars. Right. But, 20 years ago, if I lost $1,000, that probably was pretty devastating to me.
Yeah.
So, you have to, kind of, where you are right now and what you're, say like you have like a mentor or somebody that you really like love following, you can't just step into their shoes. They may say, burn the boats, leave your job, you're not gonna get anywhere if you don't risk like $50,000 or $100,000, but if all you can afford to lose is $5,000, that's where your tolerance is. And then, as you grow, your tolerance will probably get, you'll learn more about yourself. But yeah, I don't ever encourage, I hear people all the time, they're like, when I mentor them about, passive real estate or active real estate, and they're like, should I leave my job? And I'm like, well, can you afford to? And they're like, no. And I'm like, then don't.
Yeah.
That's a simple answer.
And even if you do,
I was listening to Tony Robbins, burning boats. And I'm like, and he has 33 companies and counting and millions of dollars to fall back on.
And even if you do, I transitioned from I was in the software space. I'm an engineer by trade, got in the software consulting space and saved up a good amount of money, did the house hacking, and then transitioned into commercial brokerage. You better be ready for a complete lifestyle change, especially early on in the business. I made 13 grand my first year, like going from making well over six figures to that. It's a shock. Obviously I was able to do it through, saving up and having a house hack. So I was able to limit my expenses, but it is not it's not a pleasant experience to start off with. At least I can speak from the commercial brokerage side, at least in that case, it was definitely not, it was a wake up call for sure. So
absolutely.
Yeah.
The company that I worked for back in 2017, we were still scaling a lot of our single family rentals back then. They were going through an acquisition and merger, which fell apart, but they had to eliminate a lot of the operations team and the training and development team, that's where I was.
Mhm.
And, I saw everybody above me and below me get their pink slip over the course of 6 months. And then all of a sudden here, like 8 weeks before the holidays, I was like, I'm going to make it through until January. No, they called me in. Here you go. Last day of work. I'm like, oh man. At first I was like panicked. I mean, I had 2 properties that were supposed to close, and I was like crying on my way home.
Mhm.
And my husband was like, it'll be okay. We've got we built our financial moat. Like, I knew we were going to be fine. It was more of like, being told that we don't need you anymore. That sucks.
Yeah.
But where I'm going with this is like, by the end of the day, I'm talking to my lender and he was like, no, I can't lend to you anymore. You don't have a job. And I'm like, well, my husband does. Like, moved all the loans to his name. And then I talked to my coach and he was like, Whitney, you've got X thousands of dollars coming in from your single family rentals. You're going to be okay. Like, your burn rate is not that large, if at all. And I was like, oh, right. And if I like lower all my expenses here, I have 0 burn rate and I get to spend 8 weeks with my family over the holiday season. I don't have to look for a job. And I hadn't had a holiday off in 11 years, but to your point, Raphael, I mean, it took a lot for us to get there. I mean, we didn't do lavish gifts that year. We made a lot of our guests play, but it was probably one of the best times of like my life, just to have like that freedom, that taste of freedom. You're like, this is what I'm not there yet. I need to go back. I need to figure out how to continue to accumulate, how to continue to scale, maybe get an job in the interim, but just having that taste of freedom, you're like, yes, this is what I want.
That's awesome. That's a great perspective to have, really.
Yeah. So I kind of actually want to go into the company you work for and you're involved in. So the passiveinvesting.com. Which like role do you play in there? Like, what position do you have, and how are you how's that going for you?
Yeah, so I'm the director of investor education here. And so essentially a lot of people are like, investor education. Well, I actually come from, my background is in investor relations. And so what I love doing is just talking to investors about the power of passive investing. Either as maybe they have a higher and better use of their time in their job. Maybe they're a health professional or a high-tech income worker, legal profession, they don't have time to scale a single family portfolio or even a small multifamily portfolio. I help them orient to like just going right into passive investing, or maybe they actually have all their portfolio and they're like me and they're like, I want to fire Home Depot and Lowe's. I'm tired of dealing with them. I want to fire my property manager. I help them transition, kind of think through what the goals they need to have, their risk tolerance in order to transition from active real estate into passive real estate. And I'm talking in terms of time, not what the IRS says is active and passive. So that's what my role is really helping people, work through their goals, work through the risk tolerance, educating them on our different verticals, and just educating them on syndicated investing in general. Like, it's a whole new language. It's like moving from single family to multifamily. You have to learn a whole new language. Moving from active investment, where you are running the investment, into passive investment. We changed the dictionary on people. And so they need to understand all these different terms, because they're going to run into them when they're evaluating the offering memorandums and the private placement memorandums and stuff like that. So I help kind of simplify and demystify that whole process. And as far as what we do personally is that we actually invest in multifamily, self-storage, car wash, hotel, and real estate debt in the southeast part of the United States. So think Texas, Florida, Carolinas, Tennessee, Georgia. I have to put a little asterisk on the self-storage piece, because we love Colorado and we also love Idaho as well. We're open to other markets, but that's been our sweet spot. But we can dive down anyone in those verticals, because they all have their different depending on what an investor's goals are, there's advantages and disadvantages to some of those verticals. And also just, some are commercial real estate and others are business that own real estate. So, I know that sounds very nuanced, but there is a bit nuance in between the two.
Absolutely. So, like you mentioned, because you guys do operate with the self-storage side, multifamily, you had alluded to car washes, hotels, which are more so the operating business within the commercial real estate. How, I guess, do you typically, present opportunities to these individuals based on, do you usually sit down with them and kind of go over their risk tolerance and kind of explain the different assets that you guys typically target? I guess, what is that thought process as to what you believe would be a good fit for someone versus someone else?
Well, that's funny because I'm not a financial advisor. So I have to walk a pretty delicate line here. And I would say, a lot of people are just coming into our ecosystem and they're learning about passiveinvesting.com. And they maybe heard me talk about multifamily on one podcast and car washes on another. And so they get presented with everything. They're on our list. They get to look at all the deals. We, on our phone calls, we might talk about at a high level all those different deals, but my typical call with an investor is I'm trying to learn what their goals are. Do they need cash flow, appreciation, diversification, tax benefits? Is there some other underlying, goal that they have with investing passively? And once I understand that goal, I want to understand their time horizon and also the risk tolerance. Where are they rooted in that? And then I want to understand their tax benefits. Even though that could be part of their goals, I want to understand where they want to get with tax benefits. And once I kind of have those three puzzle pieces, I will help them, by saying, hey, why don't you take a look at car washes? Because you stated that you wanted to have higher yield than your multifamily assets. You needed to diversify and you need high year one tax benefits. Let's take a look at this. But I give them all, information on all of our asset verticals, because what's very unique about us, opposed to other firms, is that you might come in wanting to invest in multifamily, but at some point in time, you're going to look up and go, wow, I've got $500,000 or 30% of my portfolio or whatever that number is invested in multifamily. I'm diversified over the market in the deal, but I need to diversify over an asset class. So, if within our ecosystem, you can diversify asset classes. That's not the case with a lot of, private equity firms. You enter there and you're like, you might get multifamily or you might get multifamily and self-storage, and that's it.
Yeah, no, and I think it's pretty awesome that you guys also, you invest in the verticals personally that, you are working with your clients. So you have that owner's experience to be able to compart to individuals, because that's obviously I have a small multifamily property here locally, but I can't tell you how much of an asset that's been for me on the advising side, because I could say, I'm an owner. I understand what you're thinking, like the logic that goes into operating something like this. So you could kind of lead off and explain how your experiences were, some of the things that you guys had to overcome in order to make sure that this property performed as intended. And so, I obviously commend you guys for that, because it's an invaluable experience that you can impart on the investors that you ultimately work with.
Mm-hmm. Yeah. And I want to just stack on, one other thing, that when investors, especially when you're investing, passively, you're giving over that day-to-day operations, which is fantastic. Much like what you were saying, Raphael, you need to make sure you're investing with somebody that has that day-to-day operational knowledge, that they know what they're doing, because that's not always the case. There are a lot of operators out there that are strictly cash in a capital raising capacity, and they don't have the day-to-day operational experience. They're, I'll just kind of set that down for a second, because I got a little off track. So what does the limited partner actually control? They can control their goals, their risk tolerance. They can control what deal they go into, the markets they're invested in, but the most important thing they control is who they're invested with. And so we have our three founders as an overarching umbrella, but even within our verticals, you're getting very diversified over operations, because, say for self-storage, we have two managing partners over self-storage. We have one managing partner over real estate debt. We have another managing partner over car washes. And so you really can achieve that pure diversification on how our organization is set up, which is the operator, the market, and the deal.
Awesome. And then I guess you kind of did a great job of explaining some of the things that passive investors need to consider as they are vetting sponsors, which, as you guys are, being able to pool money together to invest in these opportunities. Anything else in particular that you think that passive investors should ask a potential operator or sponsor about, what different opportunities?
Yeah. So there are a ton of questions. And so, I'll go over a few here, but just, if I may, if you guys go to passiveinvestingwithwhitney.com, fill out a quick form there. I have an ebook, and I laid it all out in that ebook of like the questions you should be asking the operator. It will actually back it up about your goals, about your risk tolerance, help you put together this plan, what you should be asking operators, how you should be underwriting markets, and high level underwriting and deals. But, just to kind of tease people, for the operator standpoint, you want to know, love, and trust them. Who are they? What are they doing? Do you trust them? That your gut will tell you a lot about that on that conversation. What is their track record? What is their business background and experience? For me, I have a Rolodex of operators. I don't need to invest with a new operator that's just starting out. But people have to start everywhere. And if it's a new operator that's starting out, who on their team has the experience? Do they have a strategic partner? Do they have a coach and a mentor that is investing alongside them? Who is the key partner in that deal, helping them secure the lending? If they don't have the experience, how are they getting it, and how are they assuring that you are going to be well taken care of on that front? Are they doing this full time? Are they doing this part-time? For me, it's taken me a lot of time and energy to earn my dollars, and I want somebody watching over that like a hawk. So, I'm not looking for part-time operators. We talk a lot about if they're co-investing in their deals. I want to see heavy co-investment, and not just they're putting in just maybe the acquisition fee, but they're heavy co-investment in the deals. It creates alignment. If somebody's super shady, they're going to get their money out some way, somehow. But if it's a hefty co-investment, you're going to have a lot more visibility on what happens, should the deal go sideways or south. What are their exits have been? How is that compared to the portfolio or their pro forma that they put out? I always like asking questions is like, what is the worst thing that's happened to you, and how did you overcome it? I'm not looking for perfection. I actually want to hear somebody tell me, yeah, COVID was rough for us, and this is what we learned, and this is how we adjusted. Or, yeah, we had this, we bought a property and it had we thought the galvanized piping would be an easy slam dunk to handle, but it wasn't. X number of apartments flooded, and this is how we handled it and dealt with the tenants, and this is how we changed our underwriting process going forward. I want to hear those type of stories. I want to see somebody with some battle scars on them, so to speak.
Yeah,
absolutely.
Yeah, and I think it kind of goes to show the you really learn who someone is through the tough times, right? It's easy to kind of maintain a facade when things are going great, but when things hit south, that's really where the character shows. And so I think that's a great question to ask, in that, when things are at its worst, how did you respond? Did you have a plan of attack? Did you falter through that experience? And then now you have the lessons learned that you can reapply towards your business, so that doesn't happen in the future.
Mm-hmm.
Because again, mistakes are okay if they're made once. What do they say? It's like the definition of insanity is if you do the same thing over and over and over again, expecting a different result.
Mm-hmm.
So I think there needs to be accountability in that, you've made a mistake. Now let's apply it to our systems going forward, so it doesn't happen again.
Exactly.
Yeah.
Well, and I think to stack on top of that is you want to, mistakes happen, and are they talking, because it's a partnership. I think this is what limited partners don't understand. They sometimes go in these investments and they just want to understand, what are my returns, when am I getting my money, and that's it. They think of it as a transaction, but it's a partnership. So you guys are making money together, and or potentially losing money together. But like if you're underwriting property, you're stacking the cards in the favor of making money together. Now, you want to understand that you are being treated as a partner. That's where I would try to suss that on these calls. And so in that, you need to have strong communication. What is the monthly communication? How is crisis communication being handled? What are the financials that you're going to have visibility on? Is it going to be on a quarterly basis, annual basis, so those type of things. If I hear about a storm in Texas, I've invested in 13 properties in Texas. I don't want to have to email the operator. That operator should be emailing me and telling me, hey, this is what's happened. This is where we're at. This is what we are currently doing. And hopefully starting off with like everybody that lives at the property is okay, right? Because that tenant is our client. And then, the property is okay, or if it's not, this is what we're doing. So those are the type of things I want to see, that type of communication. I don't want to have to like pull for it. I want it just to happen.
Absolutely.
I think that is really good key. I wanted to, just from going over your questions and stuff, and what really stood out with me is the risk tolerance for anything. And that includes finding the actual partner that you want to be in business with. Is how much experience are you willing to not have in that partner and everything else. So that's one of the things that really stood out to me, is just how much risk do you really want to take? And then that begins picking the right operator. So in my opinion,
Definitely.
Yeah.
I find that limited partners are often unaligned on that. Because I think especially if you're coming from this, stocks, bonds, and mutual fund world, you don't really understand. We've kind of almost been desensitized. I don't think any investor in that space, just retail investor, really truly understands how much risk they're taking by investing in the stock market. I know I didn't. And when I finally left, I have 2 shares of Berkshire Hathaway. That's all I have in the stock market. And when I finally left, I was like, oh my gosh, that was the riskiest thing that I could have ever done. I think, asking that question of yourself, because I think when people start getting into evaluating alternative investments, they want to see this really high yield and they want to have zero risk. And that's not correlated together ever that I've ever seen. Usually if you have a higher yield on the asset, you're probably taking more risk. Now, how is that risk being mitigated, right? There are a lot of ways to mitigate the risk, but you can't completely eliminate the risk in any investment.
Absolutely. No, and that's an important concept for people to understand, is that risk in and of itself typically is correlated in some capacity to yield. So the higher the yield, there are a lot more moving parts that could potentially go wrong that could affect the investment. But that's where people like you and the operators come into play to help mitigate those risks, so you can keep the trajectory on a narrow path towards success. And so I think it is a great insight to share.
Absolutely. Yeah.
So Whitney, thank you for coming on the podcast. As we start rounding out here, we really appreciate all of that. I know I benefit from it, so I know all the listeners will benefit from it, and you gave a lot of value. So one of the questions that we typically ask is, what is one of the most impactful books that you've ever read? And it doesn't have to be investing or commercial real estate. It could be any type of genre that's actually helped you maybe in your career or propelled you just in your personal life. Or is there a particular book that stands out for you?
Yeah, I'll kind of give you my little short journey on this. So I started off reading Tony Robbins' Money Master the Game, which is like a 600-page tome. But that's really where I started going, wow, I'm in control of nothing and I'm gambling in the stock market. I really started going in eyes wide open, and I was still working in my corporate job at the time. And I just annoyed our benefits manager to no end and our fiduciary over our retirement plan. So I think that's it. If somebody's really heavily invested in the stock market, I think whenever you read something like that, or he has a follow-up book that's a little bit more digestible called Unbreakable, start there. Really understand how much risk you're actually taking by just having the exposure to the stock market, because I don't think you'll sleep well at night after that. And then for me, after that, just totally devoured a ton of real estate books. I personally loved Cash Flow Quadrant by Robert Kiyosaki, because I really started to understand, how does money work and how does value creation work? And the beauty of real estate is that you don't have to go to college to get involved. You don't have to have a degree at all. You just have to have the mindset, the skills, and the network, and the get up and go and ability to execute in order to benefit greatly from this. And then on the execution front, prioritization front, one of my other favorite books is The One Thing by Gary Keller, because it's hard. Life is hard. Especially you start adding more moving parts, like a marriage or job relocation or a family, or if you're later in life and you're having to take care of additional family members, like I was. You have to start have a system not only to execute but prioritize on what is truly important to you. And I think a lot of people, if you looked at their calendars, and your calendar tells you your priorities. And I think if they took a step back, they would look at the calendars and be like, oh, that's not really what I care about at all. But you have to take charge of your time. And I know for me, I didn't learn how to do that in school. So that book was very helpful.
Yeah, no, the one thing is one that continues to be recommended, and for obvious reasons. I mean, it's a game-changing book. And I think part of the reason is because there's so much shiny object syndrome out there, where everything looks like the next greatest thing, but you realize that, you really don't achieve any type of semblance of significant success without narrowing your focus and being deliberate about something for a long period of time. I mean, all the people who have built sizable portfolios, very significant businesses, they did it one thing for many, many years in a particular direction that ultimately added up to massive results over time. And if you apply that logic to really anything you do, I believe that there's positivity that's going to come from it. So.
Absolutely. Yeah. I started off multifamily. That's all I had the capacity to learn about. And once I kind of felt like I, got a great handle on that, and then I was like, okay, now we're going to do self-storage. Mm-hmm. Once I got a handle on that, I'm like, okay, now we're going to do car washes. Now you can tell, you were like, well, Whitney, you said you had a residential assisted living and you had land. Yeah, I did get distracted, but the core parts of my portfolio that generate the wealth for us are generally in 3 areas.
That's awesome. Yeah, and they all have similarities too. I mean, there's you can use the lessons and skills that you've gained from one of the verticals into other verticals as well. So there's some corollaries, I'm sure.
Yeah, and I know when I work with kind of first time investors in single family real estate, they just can't. Initially, when they get in, they just can't wrap their head around what it will look like for them 2 and 5 years later. And I'm like, you're building up a skill set. And I have one client that I'm working with. It took her a year to buy a 3-unit property. It's taken her 6 months to buy a package of, I believe she's on 20 with partnership with commercial lending. And I'm like, you're collapsing time because you're able to stack these skills. So that's how you have somebody that is a 20-year overnight success. Yeah. They're accelerating so much faster, as time goes on.
That's awesome insight, really. Well, Whitney, we greatly appreciate your time. I know we've had this a similar conversation before on the other podcast. I'm really glad we were able to do today, because I know our audience gained a lot of value from it. Typically, at the end of the podcast, we like to ask our guests to contribute something to what we call the commercial real estate treasure chest. It's a repository of resources that we make available to our audience. And, typically our guests contribute something like a helpful PDF, if they have an ebook or anything else that they think would be of value to our audience. So I was going to give you an opportunity to share what you're willing to contribute today.
Yeah, definitely. I have an ebook. You can download it at passiveinvestingwithwhitney.com. That would be, it goes through a lot of the questions that we covered today about, setting goals, understanding your risk tolerance, vetting operators, markets, and deals. And And I think there's also a 2-page checklist for people who are like, yeah, I know these things at a high level. I just need to make sure I kind of like get all my ducks in a row for my next investment. That could be like a useful tool as well.
Absolutely. I'm sure our audience will gain a lot of value from it. So
yeah, thanks for that. We really appreciate it. So I know, again, I gained a lot of value from this, and I know you were saying that there was all kinds of questions that you can ask, people that have come in, and it's going to be clients and stuff like that. So I know people are going to have a lot of questions to ask you. Is there a certain way that you want them to contact you so they can ask those questions and maybe get in touch with you even on social media as well?
Yeah, definitely. So the most direct way is go to passiveinvestingwithwhitney.com. When you fill it, there's like all sorts of goodies there. We've talked about the ebook, the checklist. You also get immediate access to my calendar on that website. Nice. You can also find me on LinkedIn, Whitney Elkins-Hutten, and those are probably the top 2 ways to get a hold of me.
Awesome.
Yeah, thank you for that.
We'll include all that information in the show notes. So if you guys are listening to this in a podcast format like Apple Podcasts, Spotify, go ahead in the description below. You'll be able to access it. And if you guys are watching this on YouTube, go ahead in the description below and you'll be able to access it as well. So Whitney, thank you so much for your time. We greatly appreciate it. For all of you guys who are out there, if you guys are listening to this in a podcast format, we would greatly appreciate it if you could leave us a 5-star review. We've seen a significant uptick in our downloads as a result of you guys doing so. So we would greatly appreciate it if you could drop it. Obviously if you're driving, don't veer off the road, but whenever you can, that'd be awesome. And then finally, if you guys are watching this on YouTube, we would greatly appreciate it if you could like and subscribe to this channel. It really helps with the YouTube algorithm and ensures more and more people can hear this message and learn about the many facets of commercial real estate. So thank you all so much for stopping by, and we'll see you all next time.